What's up guys, welcome back to InvestingPH. In this video, I'll be sharing the strategy I've been using for years now to invest in the Philippine stock market, one that has allowed me to outperform the index by a landslide over the past 5 years. I call it dividend value investing. But before we dive in, just a quick intro. I started investing back in 2019. Yes, right before the pandemic. Just months into it, I experienced a massive drop of over 40%. Imagine seeing your hard-earned money drop that much, but because I had a solid strategy, one that's made countless investors successful, I stuck to it. In fact, I even invested more during those times because the market was so cheap. Fast forward to today, my portfolio has generated a 9.1% annualized return. I started with just 70,000 back in July 2019 and slowly built it up. Now, my portfolio is worth 3.8 million. The best part, it gives me a monthly passive income of 15,000. Now, you might be thinking, wait, isn't that just slightly above the index's average of 8%? Well, here's the context. During the same time frame, our PSE index had a negative return of 16.44%. So if you had invested in the index when I started, you'd actually be down, not up. And you definitely wouldn't be earning 15,000 a month in passive income. Philippine indices don't pay monthly dividends. My portfolio, regardless of how the market moves, keeps generating steady returns and consistent cash flow through dividends. Dividends I can reinvest to earn even more, or withdraw if I want to. But let's be real, I'm not touching it for the next 20 to 30 years. I know some of you might be wondering, how does my portfolio compare to a US fund? Well, my broker DRAGONFI offers Manulife's American Growth Equity Feeder Fund, which mimics the S&P 500 and has shown impressive growth since 2020. So I tracked it, assuming I invested the same amount monthly into that fund, and here's the result. Even though the US market clearly outperformed the Philippine market, my portfolio is doing surprisingly well, and in fact, it currently has higher returns than that fund. Will it stay that way? I honestly don't know, but just imagine, the Philippine market hasn't even recovered to its 2018 all-time high. It's been bashed by so many investors, especially local ones, with some even calling it a waste of money. But here I am, showing proof that with the right strategy, mindset, and discipline, you can still win. And the best part, I get monthly dividends. Rain or shine, bull or bear, that to me is the ultimate win. So okay, what exactly is this dividend value investing strategy, and why did I choose to use it here in the Philippine market? Here's a quick overview, which I'll break down later in the video. I invest in companies that have consistently growing earnings, consistent equity growth, well-managed debt, a solid history of paying dividends, dividend payouts that are sustainable, stocks that are priced fairly or below their intrinsic value, and lastly, proper diversification. Now that in itself is already value investing, the same principle used by the greatest investors in history like Warren Buffett, Charlie Munger, Benjamin Graham, and Peter Lynch. But my twist on it is this: I focus specifically on dividend-paying value companies. Why? If you look at the historical chart of the Philippine stock market, there's a clear pattern. Our market tends to stay stagnant for years. Examples, 1987 to 1992, even worse, 1993 to 2007, and now, 2013 all the way up to 2025, we're still in it. But even in a stagnant market, there's a glimmer of opportunity. Just because the PSEI isn't moving doesn't mean every single stock in it is doing the same. Some companies have doubled or even quadrupled their stock prices over time. So if you're good at picking those outperformers, that's one way to win. But here's what I believe is the easier and more reliable way to grow your money in a stagnant market: dividends. When stock prices drop, it doesn't always mean a company's earnings are going down. In the Philippines, you'll often see the opposite: companies growing their earnings year after year, but their stock price stays flat or even declines. What happens then? Their dividend payouts remains the same or even increase, and because the price drops, your dividend yield gets higher. This is exactly where my strategy kicks in, focusing on dividends while still buying at a discount. Even if the market doesn't move, reinvesting dividends again and again will compound your returns and grow your portfolio. The best part, it doesn't require you to actively trade or time the market. This actually helps with your mental well-being too. You're holding on to solid, fundamentally sound companies that you trust, and when the price drops, instead of panicking, you get excited to invest more. So how do you start? You don't need to spend a single peso to get all these data. There are free websites you can use to filter and analyze companies like MSN Money, StockAnalysis.com, Philjet for dividend histories, and I'll be showing some of these tools later in the video, and as well as a paid website, Simply Wall Street. But with just the free resources, you will be ready to use this strategy, dividend value investing. First, growing earnings. Wait, why not revenue? I do look at revenue too, because it's important, but for me, net earnings are what truly matters. Here's why. If a company has strong, consistent revenue growth, it's a good sign that the business is gaining traction. Even if profit margins are still low or the company isn't yet profitable, a growing revenue base is an important leading indicator of potential future profits. However, revenue alone doesn't tell you if the company is actually making money after expenses and taxes. That's where net earnings comes in. Net earnings gives you the real picture of how the company is performing because they account for all expenses. If I see a company with negative earnings, easy, skip. I don't waste time on it. Negative earnings? For sure, no dividends. In fact, I'd be shocked if a company is paying consistent dividends while in the red. If they are, they're likely using debt to pay them out, which is a massive red flag. Now, some companies do have volatile earnings. That's okay, as long as they're trending upwards in the long run. In that case, I'll continue analyzing that company. If it's negative, I'm out. Growing equity. Just like earnings, equity matters. Equity is essentially assets minus liabilities. What's left after all debts are paid. This is important because I want to invest in companies where assets are growing faster than their liabilities. The more their assets grow, the better their future earnings potential. I double down on this by looking at debt to equity and the current ratio. These ratios gives insight into how well the company is managing its debts. Debt to equity ratio. This is just total liabilities divided by total equity or shareholder equity, and you can find it easily in most financial websites. I personally look for a debt to equity ratio below 2, but here's the key. When you look at ratios, don't just use a one-size-fits-all approach. Compare the ratios to others in the same industry. For example, if you're analyzing real estate companies, compare their ratios to other real estate companies. The benchmark for what's good varies by industry. Generally, below 2 is considered safe, but some industries like telcos in the Philippines tend to have higher ratios. Telcos like Globe, PLDT, Converge has managed to lower its ratio, but its business is not as diverse as these two giants. So these are examples where higher debt ratios are the norm, but that's fine. It's about comparing these companies to the industry average. As for Dito, well, I don't waste time with companies that have negative earnings, so that's out of my radar. Current ratio. The current ratio measures a company's ability to meet its short-term obligations, debts due within the year, using its short-term asset. It provides insight into how effectively the company is managing its liquidity and debt. A high current ratio may indicate that a company has an excess of unused assets, which could suggest underutilization. This might be a sign of inefficient management, where resources aren't being allocated effectively to generate growth or returns. However, if the company is growing its earnings really well and has a high current ratio, it could be a positive sign. It might just mean that the company is holding on to a significant amount of cash flow, which could be a strategic move for future investments or to weather any economic uncertainties. A low current ratio, on the other hand, raises concerns about the company's ability to cover its short-term liabilities. This could signal potential financial distress and an increased risk of defaulting on its debts. So a healthy current ratio is essential. It shows that a company has enough short-term assets to cover its obligations, but the key is ensuring those assets are being used efficiently. A balanced current ratio, neither too high nor too low, suggests that a company is managing its short-term financial health effectively while also investing in growth. So you see, there is still correlation to the company's earnings when looking at this one. You don't just blindly look at a ratio alone. Managing debt well is also a huge indicator of strong leadership and solid management. Just look at Globe and Tel. Both companies have high debt ratios, with Tel having the higher one, but when you compare their performance, Globe has far outpaced Tel in earnings growth. Tel has had some issues in the past years, while Globe continues to outperform. I'm not saying Tel is a bad investment. I actually own shares in it, and you can check out my portfolio update video to see why I invested. But high debt can hinder growth, and this often reflects the leadership and management of the company. I can far say I like the leadership of Globe compared to Tel's. And let's just not talk about Dito, which has negative equity. I can far outright say Globe and Tel's management are far better, and I'm willing to invest in them. Poor debt management can even lead to bankruptcy, as we've seen in the past with some companies. Now, since we're diving into financials, I know you can get all this data for free, but let's be real, it can be a hassle jumping from website to website, and looking at all these numbers can feel downright intimidating. If you want to level up your investing game, I highly recommend Simply Wall Street. You don't have to hop between sites anymore because they've got it all in one place, and they present the data in nice, easy to read graphs: earnings, equity, debts, dividends, everything. They even have a portfolio tracker that lets you assess the health of your portfolio. Plus, their watchlist feature updates you when a company releases earnings, declares dividends, when insiders are buying or selling, and when the stock falls below its intrinsic value. So if you want to make your investing life easier, sign up using my link below to get up to 40 to 50% off. Thank you, and now let's get back to the video. Next up, dividends. Now, as we've structured it, we look first at how well the company is growing its earnings, equity, and how they're managing their debts before jumping into dividends. Why? Because dividends are tied directly to the growth of the company. If a company isn't growing, expect stagnant or declining dividends. More growth means more dividends, so it's important to focus on those first metrics, not just chase at a high dividend yield. In the Philippines, you can easily find companies offering more than 4% dividend yield. My portfolio's total yield is over 6%, and these are companies that meet the criteria we just discussed. I want companies that consistently pay dividends every year. To add another layer of security for your dividends, I look at a payout ratio. This is crucial. It shows you how much a company's earnings they are paying out. You don't want a company paying all its earnings to shareholders and leaving nothing to reinvest into the business. A high payout ratio is tough to sustain and can lead to stagnation. I typically look for a payout ratio below 60%, though REITs are an exemption since they are required to pay out 90% of their earnings to shareholders. So if a company passes all these checks, I move on to analyzing whether it's worth buying. The first metrics I look at are the PE ratio and price-to-book ratios. These give me an idea of what I'm paying for the company's earnings and equity. But here's the thing, the baseline for these ratios differs by industry. The best way to assess them is to compare each company's ratios to the industry average. Price-to-earnings and price-to-book ratios should be used carefully though. Just because one company's PE ratio is higher than its peers doesn't mean it's overvalued. What if that company's growth is double that of its competitors? Now the story changes. Always correlate these ratios not just with peers, but also with the company's growth. For example, let's say Company A has a PE ratio of 10, and Company B also has a PE ratio of 10. At first glance, they seem equally priced. But what if Company A has a compounded earnings growth rate of 15% over the past 5 years, while Company B only grew at 5%? Now I'd say Company A is more undervalued. I'm paying the same price for higher growth in Company A compared to Company B. The same logic applies to price to book as well. That's why I always correlate the PE and PB ratios with my computed buy price. Since my formula already accounts for the company's growth rate, the higher the growth rate, the higher my buy price. Now, I won't be discussing how I compute my intrinsic value formula here since I already have a video on that. Links in the description below. But just to give you a general idea, I project a company's earnings 5 to 10 years into the future using its past 5 to 10 years compounded growth rate, and then I discount it to get the present intrinsic value. After that, I apply a fixed 30% margin of safety to allow room for error. That's right, fixed 30% across all my computations. That way, even if I'm wrong, I still have that cushion. This formula is very simple. It doesn't account for inflation, interest rate projections, or anything like that, just the raw financials of the company. No biases, no fluff. It's less prone to overly high projections or unrealistic assumptions, and the data is easy to get from free websites. You can compute the compounded growth rate using Excel, free websites, or even ask ChatGPT. Just type in the earnings per year and let it do the math, or use an online tool like MoneyChimp's rate of return calculator. Easy. If the stock price falls below my buy price, I buy the company. If not, I just put it on my watch list and wait. Maybe one day, the stock drops to my buy price. Once you build up your watch list, it gets easier and easier. You just update it maybe once or twice a year. Rinse and repeat. Now, I just want to squeeze this into the video real quick. If you're a beginner, you can actually copy the watchlist and portfolio of investors like me on DRAGONFI. You'll see all the stocks in my portfolio, complete with their buy prices. There's also a separate panel showing which stocks are currently trading below my buy price, so that can be a quick guide for you. DRAGONFI also has a ton of features, especially in their mobile app. You can sign up using my link below, and both of us can get up to 1,500 depending on your initial funding. DRAGONFI is a registered broker-dealer, and it's the only broker I use. Thank you, and now back to the video. Lastly, diversification. I'll say it loud and clear. I am a firm believer in proper diversification. That means spreading your investments across different companies and different industries. But there's a catch. These companies must pass your checklist. Everything I've discussed in this video and more. What I showed today is just a quick filtering process. If you like a company, take the time to learn more about its business, products, partners, and leaders. That way, you'll feel like you really own the business. Remember, being a stockholder means you own a piece of the company. Be proud of that. It's a way of supporting the companies you believe in. So your responsibility as an investor is to learn about the companies in your portfolio. And of course, invest only in sound businesses. That's the real meaning of diversification. Investing in strong companies across different sectors, and I'm telling you, if you do this right, you'll have a peaceful investing journey. You'll know you didn't bet too much on a single stock, and you'll know you are invested in solid, dividend-paying companies. I can't emphasize enough how helpful this is for your mental well-being. Diversification in strong companies, it really brings peace of mind. So to wrap up this video, control what you can, trust your process, and let compounding do the rest. So that's it for today's video. If you want to follow my journey, check out my playlist of monthly portfolio updates. And if you learned something, hit that like button and share this with your friends and family. Thank you and see you in the next video.